Hello, Kumar.
Hello, good morning. How are you?
Yes, I'm fine, thank you. How are you?
I'm fine, yes. How is your preparations for the exam now?
Yeah, it's a week today, the exam. So I've been doing lots of questions.
Right.
But yeah, the syllabus is so big. I'm
I
just
know,
not
yeah, it's a
feeling.
very big syllabus.
Yeah,
Yeah,
yeah. I think although you're doing more questions and not always getting them right, it kind of dents your confidence a bit.
I know, yeah,
Um,
yeah. Main thing
but
is,
yeah, so
main thing is to remember always you need only 50 marks to get through the exam, and
yes, that's it.
yeah,
Yeah,
and
yeah.
50% of your ability is good enough to get through the exam. Just go on that basis.
Yeah, I hope so. This is it. It's so much to do in the time,
Yeah,
and
I think Seema, I think ACC examiner cannot expect a kind of a 70%, 80% performance with the questions what is setting up. Because reading the question itself takes a long time. Even if you know, you can't do it.
that's it. Yeah, yeah. And you kind of have some good study days and some days that you
Yeah,
don't
right.
do so well.
Yeah,
So
yeah, right.
yeah,
Yeah, definitely that is
I'm
also there.
hoping.
Yeah, I know. I know.
Yeah,
Anyway, just keep the confidence up. That is the most important thing. And we must
yeah,
go on that one. So I just want to look at, yesterday we were looking at the CP question. We did the big part, 35 marks. I want to go into the little parts of the paper also before I look at some financial instruments today with you.
yes. Okay.
Right? We will have to look at the bubble question also, because that was also another good question where we had the foreign conversion of the subsidiary coming up. So we will look at that
That's
one also maybe tomorrow.
yeah. Well, I have because I had to work after our session yesterday, so
Right.
I didn't get a chance
Okay.
to study much yesterday. But
Okay.
today and the rest of the week, hopefully, I will. So I
Okay.
have virtually done question one of Bubble. I was
Okay.
hoping to finish it off last
Okay.
night, but
Okay.
I
Okay.
haven't. But yeah,
Okay. Yeah, that's all right. We will continue to do that one. Let's look at
yeah,
the second part of this question. This if you really recognize, it is straight from that the article what you sent, I send it to you about the comprehensive income and other comprehensive income P&L part of it. So you
yes,
can see there are direct questions arising from those articles. So here the directors of ZIPI have heard that alternative accounting practices, actuarial gains or losses, the remeasured component can be immediately recognized in the P&L or deferred using an applicable systematic method. Right? So what they say is either they can recognize in the P&L or differ using an applicable. Additionally, past service costs can be recognized initially in OCI and then recycled to profit or loss. Right? That is what the directors have heard. So you being an expert in the financial setup, the directors are unsure as to the difference between OCI and P&L. These are the same straight note, but I sent it to you some time back. I did not
yes.
realize
I've
that
got
there was a question similar one, but this is what the thing. So in the and the ration for and for the and rationalize as to why some gains can be and others cannot be recycled. Right. So with reference to pension scheme, discuss the difference between OCI and P&L. So the question is with reference to the pension scheme. So in that article what I sent it to, it had about everything about the property, plant and equipment, about the foreign exchange gains, this thing. But here
yeah.
it's all about difference between OCI and P&L on the pension scheme. You can see almost all the questions what we did, we had something on the pension scheme.
Yes, yeah, there has been, hasn't there? And
Yeah.
I did pass an answer to this section, but I didn't think I'd answered it
Yeah, right. Let's
very
look at
well.
why some gains and losses can be and others cannot be recycled to P&L. So we know what has gone to the OCI, there are certain accounting standards which permit for them to recycle. Right? Recycle means you remove it from the OCI, or earlier it had been taken in the credit in the OCI, you remove it from the OCI and bring it to the top. That is permitted in certain standards, right? And why some gains can be and others cannot be. Include in your answer brief discussion of the benefits of immediate recognition of the remeasurement component under IAS 19 employee benefit. So there are a couple of things what is asking. First thing is to difference between OCI and P&L, and rationale why some gains can be recycled, why some cannot be recycled. Then the third one, a brief discussion on the benefits of immediately recognition of remeasurement in the P&L under IAS 19. So shall we think about a couple of points? Yes.
Yeah, I mean, the first thing that I started off saying was it's the individual accounting standards that direct when gains and losses are to be reported in the OCI and when they can be reported directly to the P&L.
Yeah.
This is a rules-based approach rather than principle.
Very good, yes. Good one.
It can be confusing. And then I've talked about pension costs, which ones should be recognised in the OCI and which ones should be recognised in the P&L.
Good.
So under IAS 19, employee benefits include service costs and net interest, which would be recognised directly in the P&L.
Okay.
Any remeasurements of the... Sorry?
Yeah, that's correct. Yes, right. Okay.
Yeah, any remeasurements of the liability, any gains must be recognised in the OCI.
Yeah.
And not reclassified to the P&L.
That's correct.
International Accounting Standard 1 defines profit or loss as the total of income less expenses excluding the OCI.
Right.
The objective of accounting for pensions is to report the costs associated with the employee benefits and to recognise over the period of their service.
Okay.
But I didn't feel like I'd really answered what was being looked for in that question.
I think you have covered up the big points there. Right? Yeah, covered up the big points because as you said, the IAS 1 basically says what is the profit and loss. Profit and loss should include all income and expenditure, including any reclassification adjustments, except what is recognized in OCI. So that's how the P&L is defined. P&L includes all items of income and expenditure, including anything that is reclassified, reclassification adjustments, except those what are recognized in OCI. And OCI recognition is always based on IFRSs, right?
Yes.
So that is what you said, always OCI recognition is based on individual IFRSs. They say basically what should be included in the OCI. So whatever that is not included in the OCI, all must be in the P&L. So as you rightly said, it is a rule-based approach. It leaves each individual standard to define what gain should be recognized in the P&L and what gains must be recognized in the ONL. Or rather it says the other way about, it says what gains must be recognized in the OCI. What gains and losses should be recognized in the OCI. Right? So, example pension scheme, as you rightly said, the service cost and the interest part should be recognized under P&L.
Yes.
The remeasurement component should be recognized under OCI, and that is not an item to be reclassified. Now this is where the problem comes up for the comparison purposes or uniformity purposes, because there are certain things what we put it which can be reclassified. There are certain things what we put it which cannot be reclassified. So that particular part is the standard is still not very clear, it gives a little bit of a gray area. There can be a kind of an argument for and against reclassification, right? Now, what is the reclassification? Because ultimately we are looking at the total comprehensive income. What is the importance of that P&L part, Fiona? What is the importance of P&L part? Yes?
No, that's showing the costs of running the pension.
Yeah, no, not the pension. I mean, if you really look at the entire P&L part, it basically reflects the performance of the company.
Oh yes, sorry, yeah, I was directing that to
I mean,
pension,
it's not about the pension, but I'm talking about the total P&L. It basically talks about the P&L talks about the performance of the company. Right? And whenever there is a reclassification coming up, it gives some kind of enhanced integrity to the profit and loss, because it reveals the realized component of the P&L, and also it reveals a kind of a useful information for the users of the financial statement. So that's the argument for reclassification. Now, what is the arguments against reclassification? Arguments against reclassification is because the same item of expenditure or same item of gain, 1 year you reflect it under P&L or under OCI, and then again you bring it and show it under P&L. So there is a kind of a feeling that it is duplicated.
Yeah, okay.
Right? It is reported twice because say for example the gain on property revaluation, you show it under OCI, and again once the asset is sold you will show it under P&L. So it looks as if it is reported twice. That's a kind of a disadvantage or an argument again. And also there can be a mismatch happening because it may be it may be reflected in 1 year, and it may come up after many years, the reclassification.
Yes.
So actually the International Accounting Standard is proposing that basically they say profit or loss should provide the primary source of information. That is, before OCI, the P&L should provide the primary source of information on the return of the entity. OCI should be only used only if it makes a profit or loss more meaningful for the user. That is why we split between the P&L and the OCI. The P&L is the primary source of information on the return on the entity. That is why we look at the operational profit before tax and interest, and we calculate ROC, etc. before all these other TCI and OCI comes up. That is why we look at the earnings per share based on profit for the year, not based on the TCI. Earnings per share. That is why we calculate the PE ratio of a company based on profit for the year, because the profit is the primary source of information. OCI should be used only if it is going to bring more meaningful information for the user. As to the benefit fund, the question is the actuarial gains and losses can vary from 1 year to the other year very significantly. 1 year it can be a loss, the other year it can be a gain. So, immediate recognition this year a gain in the P&L, next year a loss in the P&L can become very, very it can create something called a volatility in the statement of financial position and in the statement of other comprehensive income. So that is the reason why we say the remeasurement gain should be reflected only in the OCI component, never to be reclassified, because if you are going to reclassify yourself, it can, because of the volatility, because of it can vary from one year to the other very significantly, because we are going by the fair value measurement, and therefore it can bring lot of volatility to the PN.
Yeah.
So that is why it is not permitted to be shown in the PNL, and it has to be shown always in the OCI part, never to be even reclassified because of the volatility, because of the figures can vary significantly from one year to the other year. And because therefore it can be argued that the recognition can, the immediate recognition can lead to some kind of a misleading financial statement.
Yeah.
So this is what basically we should be talking about. So if you really look at the why we have these two, it's purely because of the rule-based approach. It is the each standard decides, which is not a very satisfactory kind of a way of doing things. But at the moment it is so, and therefore we can see, particularly on the benefit fund, there can be massive fluctuations, and this is the reason why we don't permit it. And the last part to the question, include in your answer brief discussion of the benefits of immediate recognition of the remeasurement component under IAS 19 employee benefit. If that has happened, you can have things like high earnings per share or low earnings per share. So probably that can be very misleading, and the comparisons can become very disparative, not so clear all the time.
Yeah.
But however, having said that one, we must ensure as people who prepare the financial statement that the users are fully made aware as to the entity's pension scheme obligations. Right? So if when we include those under other components of equity, and OCI it is shown under other components of equity, immediately there is no apparent reflection of your obligation, right? Because your losses are all shown under other components of equity. It may be a true loss, but it is not shown. It is shown under other components of equity. So there can be a kind of a distortion again happening, because your true obligation of the pension fund is never reflected, because it is always in the OCI. So there is an argument therefore that the immediate recognition will lead to greater transparency in the financial statement.
Yeah. So
this is why these accounting bodies are still struggling with some of the standards. They are not being able to really get through, because you can see, you can argue it either way. Now this is what ACC examiner is expecting from us.
Yes. Yes.
It's expecting us not to just to go by the standard, to suggest certain things into the standard, or say why the standard is good or bad. And you can see it's good and bad.
Yeah.
This is what we should be looking. So that was a kind of a thing. I'll try to pick up a note and send it to you on that one again. Then we had a third one. What was your position here? On 1st July 2016. Now we remember we prepared the PNL on 30th of June 2016. Remember, sometimes ABC has a connection. Don't forget all what you wrote in the A, because sometimes some of those information may be relevant in C or in B.
Yeah.
So it's the same company, ZP. This is after we prepared the financial statements. There was an amendment whereby the promised pension entitlements increased from 10 to 15%. A bonus is paid to the directors each year, which is based upon the operating margin of ZP. Directors are unhappy there is inconsistency on the presentation of gains and losses relation to defined benefit schemes. Additionally, they believe that as the pension scheme is not an integral part of the operating activities of the CP, it is misleading to include the gains and profit in the P&L. Therefore, they propose to change the accounting policy so that all gains and losses are recognized in OCI. They believe this will make the financial statements more consistent, more understandable, and can be justified on the grounds of fair presentation. Discuss accounting and ethical implications arising from the proposed change. First, we must talk about the accounting implications. Then we must talk about the ethical implications of this change. So what do they think? They think that there is a change in the figures, and they believe it should not be reflected in the P&L. It should be reflected in the OCI.
OCI.
Yeah. What is the accounting implication? What is the ethical implication? Start with the accounting implication. First of all, let's see whether we can do that one, whether it is permitted. All this time, you remember, up to this point, they have shown this service cost under P&L.
Yes.
Right. So if you are going to make a change in presentation, it means a change in accounting policy.
Yeah.
Right. So IS 8, accounting policies, changes in accounting estimates and errors only permit a change in accounting policy under two circumstances. One, it's a requirement under IFRS. Accounting policies of a company can be only changed under two circumstances according to IS 8. One, it's a requirement of the new IFRS. Two, it will result in financial statements providing more reliable, more relevant information about the transactions. Right. Those are the only two scenarios that we are permitted to change our accounting policy. If whenever there is accounting policy change coming up, then we have to restate our financial statements. Comparative figures must be changed. That's what the accounting policy is, how it can be changed. The only way to stay away from a new IFRS and not to change the accounting policy is in very extreme rare circumstances where the compliance with the IFRS could mean misleading the people or a bigger conflict. In that case, financial statements, you can stay away from the IFRS. In that case, you must give these reasons why particular IFRS was not implemented. So, simply accounting policies can be only changed if there's IFRS requirement, or in the opinion of the directors, it is felt that it is going to give better kind of a presentation. The only way not to comply with IFRS is to give reasons for it if it is misleading. If so, when the accounting changes, policy changes happen, the previous year's figures all must be restated.
Yes.
Now look at the IAS 19. So that's basically I explained when it can be changed. Look at the IAS 19. IAS 19 very specifically requires, there is no option given, that all gains and losses to be recognized in the profit or loss except the remeasurement component. That's IAS 19 very clear. Right? IAS 19 is very clear. All gains and losses on a defined benefit scheme, whether it is arising due to increase in the component from 10 to 15 or whatever the reason, everything must be reflected in the P&L part except the remeasurement component, which need to be shown under OCI.
Yes.
So because of that, our director's proposal cannot be justified under these circumstances on the grounds of fair presentation. What are the directors trying to do? Because of their bonus and all that, they want to show it, this particular increase that is arising, because they believe it is nothing to do with the operating activity, and therefore, but IAS 19 is very, very clear. All items, expenditure, everything relating to the IAS 19 should be in the P&L except the remeasurement.
Yes.
So therefore, the director's proposal cannot be justified on the grounds of fair presentation. Directors have an ethical responsibility to produce financial statements which gives a true representation of entity's performance and to ensure that it complies with all relevant accounting standards. So that's the account. Yeah, sorry, yes.
Yeah, I was just going to say, it does, from the paragraph, it gives the impression that, you know, they're more concerned with their bonus. Yeah,
that is the ethical aspect. That is the ethical aspect. So here there is a very clear ethical implication arising, because there is a self-interest about their bonus scheme. I think the word self-interest could have carried out of 7 marks, I'm sure 2 marks. Because when you're talking about ethical, you must show where the ethics, so it can be intimidation, duress, or self-interest, or something like that. You must have a background for the ethical aspect. So I think the key word, even if you write many words, if you don't put that self-interest, it may not carry the full mark. So there's a clear self-interest threat arising from the bonus.
Yes.
So the director's proposal to change the accounting policy appears to be motivated by an intention to overstate operating profit to maximize their bonus. Right. The amendment to the pension scheme is a past service cost. It will be fairly substantial because from 10% to 15% it is going, but as per IAS 19, it need to be charged to the P&L. Surely it is going to be detrimental to the operating profit of the CP, and therefore will depress any potential bonus. And not only that, they are thinking, they propose to change the accounting so that all gains are recognized in, and therefore they propose all gains and losses on pension scheme. So it's not only they are talking about the service cost, even about the interest.
Yes.
All gains and losses. So they want to put the entire thing to the interest. So I would have been happy if you have been able to catch up. This pension scheme, they had a net deficit and they were charging interest. So that's also done, because remember last time we charged it to the P&L. If this was allowed, it will, all that will come to the OCI, and it will enhance the profit of the P&L, and the directors will get a bonus, which is in self-interest trade.
Yeah, and is this SIPI question? This is a previous exam question.
This is one of the models they are given. So far they have not given this question. This is one of the models they are given for the new syllabus.
Okay.
Yeah, I mean, these are the questions they might put it up. So I was thinking, particularly remembering that article I sent to you about the examiners.
Yes.
And with all this kind of a question, I mean, let's hopefully, if this kind of a question comes, you probably will have a little bit of armory in your weapon house now to attack it.
Yeah. Yeah, because I was thinking over the next, probably at the weekend, I'm going to go through all the exposure drafts and the examiners.
And you know, some of the if you can go to some of those technical articles, I will also try to pick
Yeah.
up some of the technical articles. Those are the things that can definitely help you.
Yes, because they, if they publish an article, it usually means it's going to come up at some point.
Exactly. Yeah, because the article that what I sent it to was based on their article, but what I did was I just made it little simple and highlighted some of the areas. And then after doing that article, when I saw this question, I realized, oh my gosh, it's the same answer, same thing they have asked it.
Yeah. Yeah, I mean,
Yeah.
you never know
Yeah.
what's going to come up on the day, do you? You used to be able to kind of see a pattern if that on the main question,
Yeah.
is it likely to be a profit and loss? Is it likely to? But then I got caught out on that before because I totally.
That's a bit of a risky thing to go by, because sometimes they might have continuously for about 3 years, 3 exams the PNL, and suddenly they can go to the financial position, or they can have about 3 or 4 financial positions. Suddenly they can go to a cash flow.
Yes, so you just don't know.
It's a risk, it's a gamble. That's why I think, we must be ready for any of the trip.
Yes, and knowing that previously I wasn't ready for a P&L, it totally caught me out.
Because sometimes what happens is, if we get about 2 PNLs or 1 PNL, we might think next year, next exam we may not have a PNL. We might think of something else, but that is a risk.
Yes, you just don't know. Anything can come up, and the same with the.
Better be ready all the time. Finally, on this question, what we were talking about, we must talk about ACC ethical principles. So here, this kind of a treatment is very much against ACC ethical principles of objectivity, integrity, and professional behavior.
Yeah.
This kind of a treatment is totally against the ACC ethical principles of objectivity, integrity, and professional behavior. Directors must be constantly reminded the ethical responsibilities and should be discouraged from implementing the proposed change in the policy, which is clearly in their self-interest.
Yes.
And which is certainly not in compliance with the IAS 19 and IAS 8. So those are the few points I want you to note down. Okay?
Yes.
I want to go into a little bit on the financial instruments. Remember, we have a new standard coming up from next year, IFRS 9, but still we are on the old standard, IAS 39, 32. These are the standards. So, let's talk about little about a financial instrument. Financial instrument is basically any contract that in business we always have contracts. I have a contract to provide tuition to you, and you have an obligation to pay the INSAF the money. So that kind of things is what we call a financial instrument. It's any contract which gives to a financial asset of one entity and a financial liability or equity of another entity. So on one side we have asset, on the other side we have an equity or a liability. If you take a loan from me, I will have an asset in my books called a loan that is due from Fiona. In your books you will show it as a loan due to Kuma. That's a financial contract, and that is what we call a financial instrument. If you issue shares from your company to me, I will be paying you money. You will have financial asset coming up, and I will have the right for a financial instrument, but called an equity instrument. So you have to differentiate between financial assets and non-financial assets. So the most simpler way to differentiate is financial assets are very, very clear ones. Cash. Cash is a financial asset. Equity instrument of another entity. If you have invested in shares, that's a financial asset. contractual right to receive cash or another financial asset from another entity. You have sold me some goods and you have a contractual right to receive money, which is reflected as trade receivables. That is a financial asset, right? Or you have contracted, or rather you have bought some shares of my company, and that's a financial asset in your company. Then contractual right to exchange financial instruments with another entity under conditions that are potentially favorable. What is this? The last one. If you are going to put it in one line, one word, what is that? The fourth one, contractual right to exchange financial instruments with another entity under conditions that are potentially favorable. First one is cash, surely, no problem. Second one is you have shares in a company, no problem. Third one is something like a trade receivables, no problem. What is the fourth one?
Is it something like a loan where there'll be interest?
It's a loan. Yeah, definitely it's a loan, because you are going to get something potentially favorable. You are going to get something more than you gave me, the interest component.
Yeah.
That's what we call a loan. So these are the four types of financial assets what we have in our balance sheet. So examples, ordinary shares of another entity, investment in debentures, loans, etc., and lending to another entity, trade receivables, all that is what we call financial assets. So any other asset in your statement of financial position are non-financial assets. Inventory, property, plant and equipment, all that is non-financial assets. Right. Similarly, we have financial liability. It is a contractual obligation. Liability is always an obligation. It is to deliver cash or another financial asset to another entity, right? You have a obligation to deliver me cash for the goods and services that I have provided, or you have obligation to give me shares because I have worked in your company as an employee and you are told after working for 3 years I'm entitled for shares. This is what IFRS 2 is all about, shares in your company. That is a financial liability. To exchange financial instruments with another entity under considerations that are potentially unfavorable. As much as when you give me a loan, it is a financial asset. For me, it's a financial liability because I had to pay with the interest. So potentially unfavorable thing, it is a financial liability. So this is simply the way that we define assets and liability. So issue of debentures, loans, bank loans and trade payables are all financial liability. What is equity instrument? Now we said there are three types. Asset can be exchanged for a liability or for equity instrument, and that's what we call a financial instrument. So what is equity instrument? We know the assets, we know the liability. What is equity instrument? What is the feature of an equity instrument? What is the feature of shares? A main feature of shares. When you hold shares of a company, what's the main thing?
The value of them will change.
Value? Sorry, value does not change, or value changes?
Yeah.
Yeah, right. Yeah. Now, when you give me a loan, you have a right to receive that one, isn't it? After some time, you have a right to receive that interest and the capital repayment. Now, if you have an equity instrument, if you have shares in my company, do you have a right for a dividend?
No.
No, because dividends are at the discretion of the directors. Do you have a right for the capital repayment of the shares?
No.
No, right? The equity means you have a right to receive the residual interest. After paying or after settling all the out of assets, all the liabilities, the residual interest is your right. That's all. So anyway, whenever there is something of a residual interest kind of a thing, that is what we call a equity instrument. Now my question to you, preference shares, will it be equity? This was one of the ACCA questions.
Preference shares,
Mm-hmm.
so they don't give you voting rights, but they do give you preference.
Yeah, you're right. Exactly, you're right. Yeah, very clear.
Yeah.
Exactly, you're right. It doesn't give you a residual rights, residual interest. They give preference.
Yes.
Of assets before paying the equity people, they must pay the preference people. That's all. The preference shares are not entitled for any residual interest. And therefore, because of this IAS 39, preference shares are no longer classified as equity. Our time preference shares were always classified as equity. But now preference shares are not classified as equity because this definition of equity instrument which says residual interest is not there for the preference share. Preference shares only they are entitled for the preference for the repayment.
Yeah.
Paying all the people before paying the equity, they have the preference. They have the preference for the dividends. That is why they are called preference shares. There are 4 accounting standards, rather 2 at the moment. 32, it's all about the financial presentation. 39 is the difficult one at the moment, recognition and measurement. Then 7, it's all about disclosure. This is not part of our ACCA, but IFRS 9 will come up in January 2018. So better get to the exam before that one.
Yeah, well, I've got 2 chances at this exam. If I don't pass in March, my final chance is in June. So
Yeah,
I'm hoping.
Yeah. But go for the March one. We think
Definitely.
definitely
Yes,
all right. With luck, we should be able to get it through.
Yeah, and it is down to what questions come up on the day as well, isn't it?
Yeah, exactly. Yeah, because it so happens sometimes if you have done some questions like pension funds, we have done fair amount of questions. If we get something like that, we may be able to give an answer. So we have another 3 days. We'll see what we can do the maximum during this.
Yeah.
So IAS 32 is all about the financial presentation. The presentation in the balance sheet, whenever we have a financial instrument can be equity, financial instrument can be a liability, financial instrument can be a financial asset. So whenever we have that kind of a thing, the first thing we have an initial recognition, and then after that subsequent measurement. So this is what the complication in these things. Initially, how do you measure, and subsequently, how do you measure? So always what it says is it must go according to the substance, not the form, substance. Why you have to go beyond the legal form and see what is the nature of the transaction, what is behind the transaction, and we must see the substance whenever we do it. Financial liabilities is a contractual obligation, as I said, to deliver cash, or it's a loan where you have potentially unfavorable terms. Equity instrument is an instrument, there is no contractual obligation. So that's the difference between a liability and an equity instrument. Equity instrument, no obligation. Liabilities, the directors are under obligation. Preference shares, legally they are shares, but on the form they fall into the debt category because we have to pay them 7% preference dividend whenever they have a profit, or 8% preference dividend, and therefore there is an obligation, and therefore it falls into debt category. And also there is no residual interest for them, so it won't fall under equity part. So this is where another problem came. Now we know if it's a loan, what is the return we pay? We pay interest, right? Interest. On loans, we pay interest. So if it's a financial liability, we have interest. We charge interest in the P&L component, and which is shown as financial charges, tax deductible. Now the problem is when it is preference shares. Preference shares also we have to show it under non-current liabilities. But not only show it under non-current liability, the IAS 32 says that dividends what we pay must be shown under finance charges. Now this is a difficult one.
Okay.
Right? Because we have to pay dividends out of profit. But
Yeah.
presentation purposes, we have to show dividend at the top, preference dividend. Not the equity dividend. Equity dividend will never come. Equity dividend will come in always in the statement of changes in equity. But loan interest, no problem because it's tax deductible. We show it at the top. Preference dividend will be paid only if we have profit. But if we pay, that must be shown under financial expenses at the top. So when you are doing that one, we have another problem. We have to, because we pay preference dividend after tax, isn't it?
Yes.
After tax. So we have to bring it before tax and show it there. So
Yeah.
that's a thing. I mean, no calculation questions, but we should know that a question can be where should the preference dividend be shown? Preference dividend should be shown at the top of the P&L with the normal finance charges. That's the important one. See what IAS 32 says. So preference dividend will be classified as a liability and will be charged as a finance expense through P&L. Legally, it's a dividend. But for presentation purposes, it's like interest. It is should be shown in the top. Dividend paid on equity shares will be classified as equity and will be represented in statement of changes in equity. It is not an expenditure. It is out of profit. Preference shares also, preference dividend also paid out of profit, but in the presentation it will be shown under expenses. So this is a big thing in the thing, right? So that's basically something which you need to pick it up on that one. Very clearly, almost all the standards shows that financial assets and financial liabilities cannot be offset. But in the last couple of questions what we learned, we had one particular very specific example where the financial asset and the liability can be offset and only the net amount can be shown. Where was that? In the many questions what we worked it out in the last couple of days, we came across that. Yeah?
Yeah.
Where is that? Normally the assets and liabilities cannot be offset. Only it must be shown separately. But we have one particular situation where we can show the net amount. The particular IAS permits.
Is that when it's disposed?
No.
No.
Yeah. The asset, you have a corresponding liability that can be set off and the net can be shown. The question what we did just before we discussed this one, we came across that one. IAS 19. IAS 19, you remember? Net obligation.
Yes.
Pension assets, pension liabilities, set off, you can show the net amount. Normally you can't. Normally asset must be shown separately, liability must be shown separately. But one exception we have is IAS 90. So this has been a famous examiner's question, remember that one. The one of the exceptions we have is always in the pension, we can show the net obligation or the net benefit. Interest, also we can set it off. We pay interest on the obligation, or rather we charge interest on the obligation, we credit interest on the planned assets, we can set off and show the net interest. So this is one particular accounting standard which permits the asset and liability to be set off, income and expenditure to be set off, and the net amount to be shown. So then this is only possible if the entity has a legally enforceable right to set off the instrument, intends either to settle on a net basis. This is what the pension is. Pension we settle it on a net basis. And that's the only one, as far as I can think of at the moment, where we are permitted to show the net basis.
Okay.
So year 39 gives us the initial recognition, financial asset or a liability, and only when it becomes party to the contractual provisions of the instrument. Now this is a very, very important one. I think we came across this one in the last question about that 3 million, right? The 3 million,
Oh, yeah.
the directors were thinking and they charged it to the P&L. No, you
Yeah.
can't recognize it as a liability. You can't recognize it as an asset till we have a contractual provision. Right? This is what we came across in that 3 million scenario. There were no contractual provision. There was no need for us to do it. So because of that, we cannot recognize. Initial measurement should be always recognized at its fair value. And we are coming to two types of liabilities. One what we call fair value to profit or loss. Other one we call financial liability. There are two types of liabilities, four types of assets. So I'm going to talk about the two types of liabilities just now. What we call fair value to profit or loss, essentially short-term liability. Essentially short-term, like what you borrow in the money market for a couple of days, it's a fair value to profit or loss. The other one, normal liabilities, all we fall into the category called financial liability. Now imagine today you go to the market and you raise a loan of 100,000 in the money market, right? You raise a loan of 100,000 in the money market and you're a big person, you raise 100,000, you have to pay a kind of brokerage cost or transaction cost 2 million. Whoever who arranged the loan for you is charging 2 million. How much are you getting into your hand? 98 million. Right? Now if it is that kind of a thing, what is called a financial fair value to profit or loss, which is essentially a very, very short-term loan, the treatment is when we get the 98,000, we debit cash with 98, debit cash with 98, because we are getting only 98,000. Credit the fair value to profit or loss with 100,000. Add the transaction cost to the P&L. Now this is for the transaction for fair value to profit or loss. So the transaction cost is charged to the P&L.
Yes.
Imagine you go to the market and raise a long-term loan, a bonds. Same thing. 100 million, 2 million you have to spend it on your transaction cost. There, that entry is different. Cash 98, credit liability with 98. Now this is the difference. Fair value to profit or loss, transaction cost you debit it to the P&L. But if it is a fair value, if it's a financial liability, which is not a fair value to profit or loss, the transaction cost is net off and only the net liability is shown in the balance sheet. So this is very important that you pick it up on this one. In the liabilities, there are only two types. One is fair value to profit or loss. The other one is financial liability. Fair value to profit or loss means essentially short-term liabilities. So initially you will recognize first one, transaction cost charged to the P&L. Second one, transaction cost is net off and the liability is shown at the net amount. Is it clear?
Yes.
So that is what we do all the time with this liability. So initial measurement, finances should be initially recognized at fair value. Direct transaction costs are added to asset or deducted from a liability. So it's a liability. 100 million minus 298, except on fair value to profit or loss. In that case, no addition, no deduction. Transaction cost will be charged to the PN. Now, subsequent measurement of financial instruments. So, financial instruments can fall into three categories: equity, financial asset, financial liability. Equity is not remeasured after. So, whatever the original figure will remain in the balance sheet forever and ever and ever. It's never remeasured. But if it is financial liability or financial asset, then it will be remeasured in different ways. So there are four types of financial assets and two types of financial liability. I told you the two types of financial liability: fair value to profit or loss and financial liability. Can you remember the four types of financial assets? Four types of financial assets, can you remember? Yes. One is fair value to profit or loss. Both the liabilities and the assets, we have the fair value to profit or loss, which is essentially a short-term asset, short-term liability.
Yeah.
Then we have on the financial liability what we call financial liabilities. Anything which is not a fair value to profit or loss, it's just called a financial liability. But in asset side, we have four. One, fair value to profit or loss. Second one, held to maturity. Can you remember? Held to maturity.
Held to maturity.
Yeah. Third one, loans and receivables. Fourth one, available for sale. Held to maturity.
Sorry, what was that one?
The first one is fair value to profit or loss. Second one, held to maturity. Third one, loans and receivables. Fourth one, which is not falling into any of these categories, we call it available for sale.
Okay.
Actually, what IFRS 9 is doing, the new standard which is coming up in 2018, they are removing all these categories. They will have only fair value to profit or loss or one financial asset. That's all. They are not going to have many categories. So that is what IFRS 9 is going to do. Financial liabilities, I put just a little slide for you, right? It's if you look at the right hand side, fair value to profit or loss, mainly it applies for short-term instruments or what we call derivatives. You remember what is a derivative? It is a risk management instrument, like a forward rate agreement, like a futures, whatever we have. It's essentially short-term and that kind of a thing. Measurement recorded at fair value. 100 million, record it at 100 million. Transaction cost 2 million, charge it to the P&L. So 100 million will be the figure, 2 million charged to the P&L. Subsequently, every year it will be restated at fair value each reporting period. Not every year, it may be 3 months. After 3 months, we will look at the liability value. Maybe in the market data got up to 101. We will record it at 101. Originally, we recorded it at 100. Now, we see the market value of the liability has gone up and it is 101. Originally, we took a futures which is 100. Now it is 101. So that 1,000 or that 1 million will be charged to the PN. So that's, you can see on the right hand side, fair value to profit or loss, a very, very simple thing. You charge the P&L, the expenditure, and then the fair value every year, every reporting period will be at the market value. So every 3 months, maybe you will reflect it. If it's when the liability goes down, it's a profit. When the liability goes up, it's a loss, P&L charge. Now look at the left hand side, the financial liability. So other than fair value to profit or loss, every other liability is a financial liability. So bank loans, financial liability. Initially, you record it, 100 million you got it, but you had to pay 2 million, so you record it at 98 million. It at 98 million. So initially you will record it at 98. Credit liability with 98 million. But you remember, what was your total loan? 100 million, correct?
Yes.
100 million is the loan, but you got only 98 because you had to spend 2 million. But you had to pay interest not on the 98, you are going to pay interest on the 100 million. The man who gave you the loan is not bothered about your transaction cost, will ask 100 million interest. This is what we call coupon rate, maybe 6%. Right? But we have something called effective rate of interest. The examiner will tell us the effective rate of interest for this loan, because although we took only 98, ultimately we are going to settle 100. So what do you think the effective rate of interest is? Say if the coupon rate is 6%, what do you think the effective rate is? Is it more than 6% or less than 6%?
6%.
6% is what we are going to pay. But
Yes.
effective rate is, because we got only 98, we are paying 100. So the effective rate is much more than 6%, isn't it?
Yes. Yeah.
In the earlier case, we charge the P&L the straight away the 2 million. Here we are not charging straight away the P&L. We are charging over the period of the loan. This is what is happened. It's the difference, right? So because of that, that 2 million also should get added to the interest that you are paying. So although you are paying only 6% interest, the real interest is much more than 6%. That is what we call effective rate of interest. The examiner might tell the effective rate of interest on this loan is, shall we say, 6.5%. It has to be more than 6. So let's assume it is 6. So what we do is, on the 98 million what is appearing in book, we will calculate 6.5%. 6.5%. So even though we are paying only 6 million, we will charge 6.37 to the P&L.
Yeah.
With P&L with 6.37, credit liability with 6.37, so your liability will go up to 104.37. But you will pay to your lender 6 million. At the end of first year, you will pay 6 million. So this is what we call amortized cost after 1 year. You charge the effective rate of interest, you paid whatever you had to pay, and now you have a 98.37. Now next year you start with 98.37, charge 6.5%, pay 6 million, at the end of next year you will have. And you can see gradually it will increase to 100. I mean, if the effective rate was taken, it will increase to 100. Because you can see from 98 it went up to 98.37. Next year it may go up to some other figure. And slowly it will increase to 100, and at the end of the final year you will pay the 100, and that's how the loan will get settled. So this is what we do with the normal financial liabilities. We work it out on what we call amortized cost. Fair value to profit or loss, we look at the market value of the loan and we take it up. But here we don't do that one. We work it through the normal thing. This is what the way to treat the financial liability. So equity, no subsequent measurement, whatever the measurement, that will remain forever. Fair value to profit or loss loans, subsequently it will be measured at fair value, gain or losses charged to the P&L. If it is financial liability, which is not fair value to profit or loss, it is measured on amortized cost, and the effective charge, effective rate of interest on the opening balance is your P&L. So this is what we do. Now we have to do a little bit more. I will do tomorrow when I meet on the asset side.
Okay.
Asset side. That's the next one, the compound interest and financial assets. So I told you there are 4 types of financial assets. This is very important. We will look at these things. So probably we'll spend a little bit of time on this one and we'll finish that one, and hopefully tomorrow if you can do the bubble question, we should be able to look at the bubble question also.
Okay. Yes, I'll look to finish that off today, and then I'll send that to you later on.
Right. Okay. So I'll see you tomorrow at the same time, Fiona.
Yes. Okay. Thanks very much, Kuma.
Yeah. Have a great day.
You too. Bye.
Bye. Bye.